we're going to get started here in just a moment. But before we start on our conversation, I've got a little graphic we'd like to put up. If we could put up the graphic, that'd be great. The big news in the world of antitrust and Silicon Valley is the announcement yesterday that the Federal Trade Commission is interested in what we do here. And they're going to be, could we put up the graphic, the press release? And that they're going to be conducting an investigation of the acquisitions by major Silicon Valley firms, including, for example, Facebook. And they're going to be looking at the deals that have been too small to be registered with the government under the HSR criteria. So between all of the deals that have been cleared with HSR and the deals that haven't been cleared, the federal government is going to try to do a deep dive to understand, in effect, every M&A transaction that's been done by the major platform companies here in Silicon Valley. So that's something that's coming. We should all be aware of it. There is, however, something unbelievably delicious about the FTC announcement that just had me chuckling, all right, when I read it. So what you have is the headline, FTC to examine post-acquisition of large companies, and it mentions that we're going to be looking at Facebook. If we scroll down towards the end, please, and the highlighted, and then they ask you to like us on Facebook. We're going to investigate Facebook, but please like us on Facebook. And it reminds me of the old Rolling Stones song, I Can't Quit You, Babe. All right? So, I mean, it's you know, the sense of irony and chagrin. You sort of wonder, is anybody at the FTC actually reading the announcements that they're putting out over here, or what's going on? So this is what's going to be happening for the next several years here in Silicon Valley. These investigations never happen quickly. So with that by way of introduction, Mike, how did a profoundly nice guy like you wind up as a venture capitalist? What went wrong?
People don't know the fact that at Sequoia we've had a diversity hiring program for decades. And I actually was the first participant in this because Sequoia had never, ever considered hiring somebody who didn't know anything about technology and was a history major. And worst of all, from another threatened minority that never, ever hired anybody who was a journalist. So I was the first example of Sequoia's diversity program that came into action, and that's how I wound up in the venture business.
And you were originally a reporter.
I was.
A little bit about your background, your education, and how were you supremely unqualified to become one of the great venture capitalists of all time?
I grew up in Wales, and like Macon, I became an immigrant to this country, and wound up for a few years working at Time magazine as a reporter, and then came to Silicon Valley with Time magazine, not really knowing where California was at the time, or certainly not being aware of the fact that there were things called technology companies that operated in California, or that technology companies could be started by 19-year-old people. This was an entirely foreign concept. All of these were entirely foreign conceptions to me. So I came out here at the time while Apple was still private, and Genentech was still private, and Microsoft was still private, and gradually became familiar with the tapestry that these days is called Silicon Valley. And some years later decided that I wanted to do something other than journalism, which is when I entered the Sequoia diversity hiring program.
And nonetheless, the diversity hiring program continues. They haven't learned their lesson.
Not a lot more historians or journalists, but fortunately, a lot more people from all sorts of varied and interesting and complementary backgrounds.
So what are some of the more notable investments you've made over the years?
Well, Sequoia has been very fortunate, and Sequoia as a firm, and you know, we started in California, just up the road here, but today we operate also in China and India and Southeast Asia, and we have investments in Europe as well. And we're interested in the growing technology companies of tomorrow. And so going way back, just to rattle off some names, it would be businesses where we have been involved very, very early on would include companies like Atari and Apple and Cisco Systems and NVIDIA, YouTube, PayPal, Flextronics. These days in China, Meituan in particular, and then a whole raft of Google and YouTube and Airbnb.
So this is a guy can say, oh yeah, and we also did Google, just by the way.
And Stripe. And so we've just been very lucky to have been positioned in the place where so much activity has occurred.
And when you look at all of these different investment opportunities, are there any particular themes that strike in your mind in terms of what is it that you're looking for in a new company that makes you go, yes, wow, I'd really love to invest in that?
I've gradually learned this. I didn't know it at the time because I was around 30 when I joined Sequoia, which was now 35, 36 years ago. And I didn't appreciate then what it took to develop a company of real merit. And obviously when you're young and trying to get started, you're really just trying to make your mark and to make your mark as quickly as possible, and you don't have a sense of the longer time horizons. But I think after 3 or 4 years in the venture business, I really began to understand how long it took to develop the companies that we're really interested in, the companies where we can be participants and shareholders. And I know this will sound very strange to most people in this room, for a very, very long time. And for the last 15 years or so, in 15, 20 years, whenever I've met people, I've been thinking at the back of my mind, is the purpose and the mission that this set of founders, this founding team is contemplating, is this, if it comes to fruition, knowing that a lot fall off along the way, is this something that I can imagine we will be shareholders or participants in 20 or 25 years from now? Because that's what really matters in our business. And Macon in his introductory remarks was observing about the paucity of IPOs in the last several years. And I think some of that is a reflection of the long-term investment horizons of private technology investors. So we have an investment in, when I got into the venture business in the 80s, a company would go public probably within 3 years of a firm like ours financing them. And they'd go public with de minimis market caps. And I think Electronic Arts, which was another company that we were involved with from the inception, its market cap at inception was $80 million at the IPO. And
you don't do that today.
They don't do that
Can't
today.
be done.
Microsoft in 1986, and this was considered, even if you adjust for inflation, this was considered an enormous valuation at the time. It was about $450 million. And today, we're shareholders, very happy shareholders, of companies that already have been up and running for 10 or 11 years, and they're private.
Stripe.
And some of them are staying private. Or they have no immediate plans or needs to access the public market. So the fact that there have been few IPOs, say, compared to the 80s or 90s in the last 10 years is a bit of a red herring, I think.
I think it's a tremendous red herring. There are other things to think about. If you look at the data, the number of publicly traded companies is down from the peak in 1996 by approximately 47%. And when I teach this stuff to my students, I sort of say, what's your favorite mammal? Everybody says either human beings or dogs. And they say, would you notice, all right, if 50% of the people in the world disappeared? I go, yeah. 50% of the dogs disappeared? Yeah. Well, 50% of publicly traded companies have disappeared. Do you know? Do you care? Should it make a difference? And it fits in exactly with what Mike is talking about. The vibrance of the private capital markets has grown so tremendously over the last 20 years, we can now fund private companies basically in perpetuity. If you've got sufficient liquidity, if you can provide liquidity for the VCs, liquidity for the employees, there's no longer a practical need to take a company public. And you know, I think we're going to see more perpetually private unicorns and companies that are able to thrive and be very significant competition to established firms without ever conducting a public offering or going into the public market.
Right.
So, you know, one of the big themes of this session is this notion of kill zones. Talking first about your perspective, and then we'll get to other people's perspective. Do you perceive anything like a kill zone? How do you react to the notion of a kill zone? Should people be worried about kill zones?
Yes, but it's not the answer, I think, that perhaps some people might expect. So I'll give you two examples, one from yesteryear and one from more recent contemporary times about kill zones. One is called the USPS, the United States Postal Service. The other is called NASA. And when the venture industry in the early 1970s, or some brave venture capitalists decided to invest behind a young gentleman called Fred Smith, a Vietnam vet, when he started a company called Federal Express, most people thought it was going to be a suicidal mission because he was going to get killed by the United States Postal Service. A more recent one, and a very contemporary one, is SpaceX. The reason that Sequoia didn't invest in SpaceX was that we thought, I remember talking to Elon and saying, goodness gracious, do you know who the competition is?
Oh, you didn't say goodness gracious.
It's NASA. You never want to compete against the government. And more recently, I think we've found that the kill zones would consist of, depending on which company you're involved with, deeply entrenched political interests within cities that can really stymie the development of the next generation of hospitality and mobility companies, hotel lobbyists, people who dole out medallions for taxi services. There are a whole load of hidden killing zones that people don't recognize that are far removed from, you know, the general object of interest in a conversation or a set of topics like the ones that are being broached today.
So it's interesting. So from your perspective, the kill zone is not generated by a company like Facebook or Google or Apple. The kill zone is generated more by regulatory structures and by forces, in effect, of the state that make certain forms of innovation difficult or impossible.
Yeah, I think that is the greatest impediment to the creation of a lot of small companies, in particular the ability to go fast.
Now,
and not get caught up in things. I've heard, and I understand the interest aroused by, by the circumstances of today, but call me a little bit jaded because I've just heard this argument for decades. And let me just talk about 4 different decades with an effort to try to put today in perspective. So there once was a dominant company in the semiconductor business called Fairchild Semiconductor that was really the progenitor of 99% if you were able to go on to one of these ancestry and genealogy sites, pretty much every technology company in the world today traces its roots back to Fairchild Semiconductor. This company was so dominant in the late 1950s and early 1960s that nobody felt you were ever able to be able to compete with it. In fact, one of the gentlemen who was running it, Bob Noyce, who later became one of the co-founders of Intel, felt that there would never be another semiconductor company created in the world because of the dominance of Facebook. Fast forward to the 1970s and the 1980s, and it was exactly the same argument about IBM. How IBM was so dominant, so monopolistic in its tendencies, that there was no chance of anything other than sort of fringe little computer companies ever being able to participate in that business. Fast forward into the 1990s, and you have Microsoft, and obviously Microsoft was the subject of much government scrutiny in the 1990s, and it would have been considered impossible, or it was widely considered impossible to compete against Microsoft. And then today you look at the market values of Facebook and Google, both of whom were up against Microsoft in different ways, particularly Google. And their market caps together eclipse the Microsoft value. You look at the Intel Corporation of the 1990s. Intel was considered, nobody felt that they in America could compete really against Intel in the IC business. And then along came NVIDIA, along came Broadcom, along came Qualcomm. And so I don't want to appear jaded or dismissive of the issues today, but I've just heard it for so long. And I have a little tagline at the bottom of every email that I send out that's 3 words: anything is possible. And every time we invest in a small company, there is every reason to believe that this is mission impossible, and that there are surrounding forces that will make the journey very difficult. And over and over again, repeatedly, despite all the naysayers, that has never proven really to be the case in any particular generation of the investing that I've been involved with or am deeply aware of.
And to loop this back into the concern that the FTC announced and that the Antitrust Division has, there's a concern that a lot of these dominant company platforms, and what you're saying, and history suggests that there's a lot of truth in what you're saying, is that today's dominant firm is tomorrow's distant memory.
Yes.
Is that these dominant firms will be able to maintain their dominance and perhaps put off the day of reckoning by either scaring new competitors away, or if a new competitor emerges, acquiring that competitor so that the next threat to Facebook never emerges because Facebook acquires it. The next threat to Google never emerges because Google acquires it. Now, one of the fascinating things is if you Google Mike and if you see his page on Sequoia, there's a line in which, they ask the question, what's one of the things you hate? And Mike's answer is when one of our portfolio companies sells. Can you explain why that is and why that's really directly relevant to people's concern here?
It loops back to what I was saying earlier, which is, and obviously there are some circumstances where perhaps, the market has changed or the product fell short or something where, quite understandably, the founders of a company want to sell. But when we have an opportunity where we feel we do have one of these 20-year horizons, we're very interested in participating for the full 20 years, understanding the pressures that people can come under from time to time. And But if we feel that there's a tremendous amount of runway, and we're sometimes in this very fortunate position of being one step removed from the fray of the daily battle, which is, the hurricane that surrounds the people, the founders of these companies, and the people running the companies in which we're investors. And we're able to have the opportunity of stepping back a little to see the place of a particular company in an industry. And if, gosh, we are 3, 4, 5, 7 years into an opportunity that seems boundless, we always want to continue, which is why years and years ago I was in, people, I don't want to dig up ancient history, but I was always very opposed to the sale of PayPal. Because I just felt it had this enormous market opportunity that lay ahead. But then there are other examples, and I know, again, this won't be seen as satisfactory for some of the arguments that might be made. But when Google, for example, in 2006, bought YouTube, they saved YouTube. The killing fields at YouTube, it certainly wasn't Google. The killing fields were called Universal, Warner, Sony, with their battalions and phalanxes of lawyers, their ferocious attack dog agents, who were making these extraordinary threats of annihilation to this little company that for the first 8 or 9 months of its existence worked out of our office. They were the killers. Google was the savior, which is why YouTube today thrills, entertains, amuses, and diverts hundreds of millions of customers around the world. Nobody tells that story.
So what's really fascinating is inadvertently, Mike has hit on 2 companies that involve 2 of my former students. So Gideon Yu was CFO at YouTube, and Gideon loved sitting and telling the story that they were this close to bankruptcy at YouTube, and he can't believe to this day that he actually persuaded, he doesn't use the word persuaded Google to actually buy a company on the verge of bankruptcy. And he says his view is exactly the same as yours. And then Peter Thiel, another one of our former students, was the founder of PayPal, and it was the controversial decision, from Mike's perspective, to actually sell PayPal when Mike would have preferred to keep that company going. Mike's perspective also fits into something really important about the economics of Silicon Valley. The returns in the Valley today are driven by a very small number of hugely successful companies. It's not a normal distribution, it's a power law distribution. Very small number of companies drive a huge percentage of the returns to Sequoia, to Benchmark, to all of these other companies. And you're really able to get those returns as a practical matter if you don't sell a company too soon. All right, if you sell a company early on, you're going to get a double or a single. You want the grand slam home run, you really have to push for the longer ride.
Yeah, I think that's right. I think sometimes, obviously a tongue-in-cheek remark, sometimes I think of the best venture practitioners making Warren Buffett look like a day trader.
That's exactly right. And it also fits into the observation that if we evolve the financial model here in Silicon Valley so that we, in effect, never need to take a company public, you take a company public only for other reasons, it really disrupts the whole business model in an entirely different way. Mm-hmm. Why do you think, Mike, so many people are concerned about kill zones, companies being squashed, acquisitions that wind up stifling new competition? In other words, why are we here? Why do we have this conference if you don't see the problem?
The view always looks different from afar, because if you're sitting in a venture firm, you can look at some of these admirable companies, and I don't mean to criticize any of them, but they, today, given their heft and size, they're very slow moving. Because they have so many people. And they are also places that have trained lots of people and lots of engineers in very skilled ways so that they provide fertile fuel for many of the startups around the valley. And I think there are many people who sit inside these companies thinking, goodness, we can compete against them. And they have an idea, and and we and others talk to them, and feel, and obviously we go into all of these things with eyes wide open, feel quite phlegmatic about competing against some of these companies in the fashion that we went up against, or, you know, in yesteryear, the semiconductor companies went up against Fairchild, or in a later generation, Intel, or people went up against IBM, or these days people go up against Cisco Systems, et cetera, et cetera. So I don't think today is any different from 20 or 30 years ago. And all of these companies are vulnerable in some fashion or another. The thing that interests me more about this is the company that we haven't talked about that was broken up in 1982 and the consequences of that breakup, which was AT&T. And the consequences of the Settlement Act of 1984 and the Telecom Act of 1996. And I was thinking, I live in San Francisco, so I was commuting down here, and all of you know the trouble with cell phone coverage between the two hubs of Silicon Valley, Palo Alto and San Francisco, where it's impossible to have a 30-minute telephone call without the signal being dropped 25 times. And I was wondering, and really haven't really seen a study of this, about the long-term consequences of the breakup for AT&T, for the communications infrastructure of America. And in particular, when you go and visit China or other places that have very advanced communications infrastructure, I would love to see an analysis of the communication, the quality of the communications infrastructure of AT&T of America had AT&T stayed intact, and also, given that this is much in the news, how well the U.S. potentially might have been positioned. Again, I realize this is hypothetical against another bogeyman of today, which is Huawei. And I think the consequences of both of those things go back to what I think in retrospect was a very ill-advised breakup of a company that was already operating under a government-sanctioned monopoly and services agreement overseen by the FCC.
Let me put a pointed question to you. If a company came to you and said, we have a business plan where we want to compete directly against Facebook, we want to compete directly against Google, we want to go up against Amazon, would you summarily throw them out of your office, or would you say, tell me more?
I don't think any founder or entrepreneur with their wits about them would say that. Because that's not how companies start. Companies start with a very narrow focus. And they do one small thing very well, and they become the best at it, and then they gradually expand. Google, the founders of Google never said we're taking on Microsoft. The founders of NVIDIA never said, Jensen Huang, he never said, I'm going to be taking on Intel. They start with a very narrow focus. And you'd never want to invest, it doesn't matter what the name of the company is, you'd never want to invest in somebody whose ambition at the outset is so big, so broad. That makes no sense.
And that might be something that the antitrust authorities at DOJ and at FTC might want to incorporate as they try to understand what goes on.
All we're trying to do is do one very, very small thing better than anybody else.
And from that, you potentially get all of the scale, all of the network effects that lets you grow and do something else.
Correct.
I think that's really
Correct.
exactly right. We've got a question from the audience here, and that's, if companies stay private longer, how or when will VCs obtain an exit that they want?
It's a reasonable question looked at from the outside, but there's a surprising amount of liquidity inside the private market. So if somebody has shares in, and you know, assuming that the company is doing well and it's flourishing and prospering, there are always buyers for the shares. You can't go onto a Bloomberg terminal or call a broker to do it, but these transactions happen regularly and have become really a way of life in many of these companies. It's a way for employees to cash in some of the options that they've vested. It's potentially when there are early investors who want to sell, it's an opportunity for them to sell their shares. So it's not a major issue.
So this is the interesting thing. You can build liquid secondary markets that generate very fair pricing without taking companies public. And as long as you have liquidity for the VCs, that if they need to get cash to pay out limiteds, funds are closing, what have you, limiteds need the cash. If you're comfortable that you can actually get the cash at a fair price within a reasonable time horizon, you don't need to go public. More interesting and complicated question is treating the employees fairly. Employees are at the company, they've got options. If the company does really well, the employees deserve making millions and millions of dollars, and they need to know that they're going to get fair value for their options and not run into all sorts of complicated questions. I now have to pay a huge amount of money to exercise my options, and I have to worry about tax consequences and the like. We can do the legal engineering here in Silicon Valley to, I hope, restructure option arrangements, restructure investment arrangements, so that the idea of the perpetually private startup actually becomes a reality. And Mike earlier mentioned Warren Buffett and his economic model. That's something else we're thinking about moving towards in Silicon Valley. Do you want to talk about permanent capital?
You should do that. I haven't thought very much about that.
So all right, I'll talk about it. So I'm chair of the audit committee at KKR, and this is not a state secret. The business model that many people love is Warren Buffett's. Warren has, in effect, permanent capital. He grew it through very astute knowledge of the insurance industry and the like. He now has other bases for permanent capital. And you know, a lot of us in the investment business want to get out of what we call the hamster wheel, that you've got a fund, the fund has a 10-year life, you might be able to extend it to 12-year, but at some point you're in this situation which is paradoxical. You've got a whole bunch of really good investments. You want to keep them for another 20 years, as Mike says. You want to be an investor forever, and because you've got to close the fund, you've got to sell out positions you don't want to sell, and you've got to move on. If you've got permanent capital, you don't need to worry about that. And public information, at KKR, we've been bulking up our balance sheet just like Warren Buffett, so that we're able to co-invest with our funds, and in many situations, keep these positions that we really like in perpetuity. The issue then, of course, is, are we as good investors as Mike Moritz and Warren Buffett and the like? Well, the only way you're going to find out is by doing it, and we'll be able to have a verdict.
We're in Sequoia, we're so lucky in so many ways. One of the things that we're lucky about is that, you know, we've been in business a long time and have a record with our clients. So we have never felt pressure about fund limits and the need to distribute capital. You know, we have clients who've been with us 40 plus years. Mm-hmm. And they're very comfortable with us.
Let me tell you a story about Sequoia. All right, so number one, they're in a blessed position. They don't have to worry about fundraising. They have more money that comes at them whenever they want to raise funds and they want to take. But here's the thing. When you go and you visit their offices, what are your conference rooms named after?
They're named after our clients.
Okay. So how's that for love? All right. So instead of like, at a lot of organizations, you name it after, hiking places or resorts, or artists. You go to Sequoia and the conference rooms are named after their long...
But there's a naming opportunity, Joe, so if you'd like to call our conference room the Grunfest room, we'll arrange for payment.
Yeah, that's the one without the windows where the heat, all right, is turned up.
That's right.
Any other questions from the audience for Mike? Sir.
Epidemiology is in the news as a field, what's going to happen in terms of viruses and so on. And any companies which are working in those areas, which can now be capitalized well to understand how any epidemic spreads.
Yes. So
Things compared to what China is doing is blindly doing something, but not understanding.
Could you repeat the question?
yeah, I will. There are private companies working in the field of epidemiology, in particular tracking down viruses. This will sound like a commercial, pardon me for doing so, but on the way down, we have an investment in a company in the East Bay called Berkeley Lights, which is a biotech platform engineering company that can screen cells faster than any other company in the world, and their systems are now being used to try and speed up the search for antibodies that can attack, in this particular situation, the coronavirus.
The spreading methodology is what happens,
Right.
what if kind of a thing, and in silico approach to a solution to viruses. Yeah, I'm KRS
So that's virtually what this company does. One other thing about killing fields, and again, I realize this is a little bit off topic, but it's germane for this audience. I think the real killing fields here are the school classrooms of America, which is the future. And that's where we're killing ourselves. We're killing the future technologists of the United States. We're slowly killing the potential for homebrewed invention. You have a look at the test scores, the PISA test scores, the global PISA test scores, to see where the US ranks. And it's just shocking. And you look at the top four the four largest eastern provinces of China that come in number one in math, in science, and reading. And those four provinces have a population of 180 million, greater than half the United States, greater than the populations of the United Kingdom and Germany combined. And that's where it's educated people, is where tomorrow's vibrant Silicon Valley will come from. And unless we address the problem in the real killing zones, which is the educational system at the high school level in America, we're never going to be set up well to compete in the long term.
And on that uplifting note, if we could have a big round of applause for Mike.